Hi, this is jeng, and today we're going to be talking about fixed rates versus floating rates, and why people are looking at floating rates a little bit more now, and then sort of the process through those deals. So let's just start with sort of why floating rates now. And a lot of people have been tracking the Fed, and this is probably the most interesting chart. Is all right. So if Libor right now is, let's say, 10 basis points, and then it is not projected to hit 1% until October of 2028. So 8 years from now, they're expecting Libor to hit 1%. So essentially for the next, let's say, 3 years, they don't see it moving. And then the SOFR line is right behind that. So it's essentially flat, about under 10 basis points. So Powell not only said, look, we're going to keep rates low, but then also they're going to look at an average inflation now. So instead of just targeting 2% and now raising rates once it hits 2%, they're going to look at an average. And so the rates essentially need to go to, let's say, inflation needs to go to 4%, and then that's when they would start raising rates again. So the signaling from the Fed has just been that we're going to keep rates low. And so a lot of people historically, let's say the last 5 years or so, this chart goes back to 2015, is that, a lot of people took fixed rates. And so why haven't people looked at floating rates previously? And if you look at this curve, I mean, effectively the federal funds rate uh, kept going up. So they kept raising rates over time. And so there was always this hint of, rates are going to go up. So I might as well fix in the rate before it goes up. But then, essentially July 2019, it fell, federal funds rate came down. And then, once this was March 2020 right here, once that hit, federal funds came all the way down to zero. 10-year Treasury followed that track and came all the way down. And the big thing I would say, and I had to sort of go back and try to find this, so they compared when you go out and do a floating rate loan, you have to buy an interest rate cap. So we're going to talk about interest rate caps a lot, but on this particular pricing, so in 2018, here, when people are expecting rates to go up, the cost of interest rate caps are very high. So this was an example of a $50 million deal, 3-year cap at 3% on Libor, and it was $400,000. So can you imagine buying a cap on your loan costing $400,000? Whereas in 2019, May 2019, it dropped down to only 51,000 once rates started coming down, and that has been the trend the last 12 months. Is that as rates have essentially gone down, and now that there's a projection that it will stay low or lower for longer is what they keep saying, and interest rate cap pricing has gone down significantly. So we're gonna get into interest rate cap pricing a little bit later. So when you're looking at multifamily loans out there, in terms of fixed versus float, so bank loans typically are fixed. Freddie Mac SBL is fixed. Freddie Mac conventional has a fixed and floating product that we're going to look at. Fannie Mae right now has a fixed product, but they are trying to get a floating rate product out there into the market. And then bridge loans are typically floating as well. The difference, I would say, is the bridge loan is for deals that are maybe not stabilized, so not 90% occupied for the last 90 days, and their rents are lower than market, and so you're not able to size to the leverage that you want to get. So right now we're going to compare sort of that Freddie Mac conventional and the Fannie Mae. So the Freddie Mac conventional, it needs to be above $7.5 million. And then the big thing here is this prepayment. So on Fannie Mae, people are used to yield maintenance, which is an expensive penalty. It can be anywhere from 10% of the loan amount up to 20% of the loan amount, depending on how soon you prepay it and how much term you have left. And then this is the big thing on these floating rate loans, it resets every month. And so right now it's a 12-month lockout, and it goes to 1% prepayment thereafter. So let's go through Fannie Mae, then we'll go through Freddie Mac and talk about the process. So pre-COVID, so before March 2020, you're out there and Fannie Mae has pretty low rates, right? So it's 4% rate. And this is when 10-year treasury was maybe 1 to 1.5%. And we thought these were the lowest rates ever. I mean, when people were locking in the threes, high threes, people were celebrating. So you got, you locked in the rate, you had high leverage, 75 to 80% on this particular deal, 3 to 5 years IO, it was assumable, and supplementals were available. So everybody was happy. And then COVID happened, 10-year treasury went down 150 basis points. And guess what? Rates have come down. So post-COVID, similar size deal here, about $20 million. You can see that the rates are anywhere from 265 on a green program all the way up to 320 just on a regular non-green program. So, people are still doing these loans. People are still doing Fannie Mae loans because they get sort of that locked in rate. They're getting anywhere from 1 to 5 years interest only. It's relatively low closing costs. It's assumable, supplemental. And then if you're 1 to 7.5 million, this is all you really have. I would say what people are starting to look at a little bit more now is, instead of going out on the yield maintenance for the 11.5 years, they're pulling that back. So you can do a 10-year loan term fixed and then maybe a 7-year yield maintenance penalty. Your interest rate's going to go up probably about 25 basis points, but then you have a lower prepayment penalty. And then some people are even doing step down. So you can get to these loans quoted step down. It might add another 25. So you, instead of 3%, you might be at 350 on a step down, but then you have an easier exit going forward. So if you're scared of the yield maintenance penalty, you can still do Fannie, but with different prepayment penalties here in this box. So let's go over to Freddie. So Freddie conventional historically has been more of your Class A, Class B property types. And you can see the fixed rate all in right now is about 290 to 3%, whereas the floating rate is about the same. And so it gets to about the same loan amount. The big difference is this prepayment structure. So, when you normally look at a deal and you say, all right, you can fix the rate or float the rate, and it's the same rate, you would typically take the fixed rate. The big difference is the prepayment structure. So let's talk about the prepayment structure, maybe go through an example. So I would say before you jump into Freddie floating rate loans, I would, it has very similar things around non-recourse, 80%, interest only, longer term loans, and it has lower net worth requirements. So this is actually a big thing. So when you have, let's say, a $20 million loan on Fannie Mae, you need $20 million net worth. Here on Freddie Mac conventional, you need a net worth of at least 50% of the loan amount. So you're going to be in that, let's say, $10 million loan amount for that deal instead of 20. And then on the disadvantages, you need to get up to 7.5 million on your loan amount. And this is a big thing. So every deal has to be approved by Freddie Mac. This can take anywhere from 5 to 10 business days. And they are typically more conservative. So they might come back instead of like 80% loan to cost, they might be at 75 or 70. And there are higher closing costs than Fannie Mae. So you go by the interest rate cap and your legal is typically higher. So let's go through a case study. So this is a 250 unit Class B deal, $26.5 million purchase price. It's at 95% occupied. So let's compare Fannie and Freddie. And so Fannie 20 loan amounts the same, leverage is the same, loan terms about the same, 10 years, interest only 3 to 5 years. So interest rates are on top of each other, right? So Fannie is going to be fixed at 3%, Freddie floating at 3%. This is a big thing, right? So you're not going to buy an interest rate cap, but with Freddie, you do buy the interest rate cap. So I'm assuming these are priced over SOFR now. So SOFR is what they're going to be priced off going forward. And the interest rate cap, let's estimate at $50,000. And then the prepayment yield maintenance versus the 1% prepay. And then the net worth requirement is going to be different. So this actually should be 20 million. So $20 million on Fannie and then 10 million on Freddie. So let's jump over. So let's look at the difference, right? So once you get into the deal, Fannie Mae, $20 million, 3%, 10 years, 3 years IO. This is your prepayment penalty on the top for when you actually prepay the loan. So if most indicators are out there, they'll hold the deal for 3 to 5 years. And so this might, after you hold the deal for 3 years, if you pay it off and it's yield maintenance, it's a $3 million prepay, right? In year 5, it goes down to 2 million. So it's essentially going down about 500,000 a year until year 10, zero. Whereas the Freddie Mac side, conventional floating, that first year you're going to be locked out, so you cannot prepay it. Somebody can assume it, but you cannot prepay it, that loan. All right, so you're going to buy the cap, that's 50,000, and then let's say interest rates did go up. Nobody's expecting them to go up, but on this, we're basing this assumption on 25 basis points and increasing that 25 basis points over time. And so, what you'll have is, let's say you pay it off in year 3. It's a 1% prepay, so 1% of the loan amount, and then the additional interest. So let's say 50,000 plus 100 plus 150, and that is your total right here. And so I did just sort of a rough calculator down here, comparing your yield maintenance versus if you did pay the exit, the interest rate cap, and the additional interest. And you can see here that, essentially, year 3, 4, 5, 6, you come out better with the floating rate loan. And then if you do get into year 7, the yield maintenance penalty has come down so much and you've paid so much more additional interest that you are actually better off with the fixed rate if you held the deal for that long. So a couple notes, I would say, for everybody who's looking at doing a Freddie floater, I would say interest rate cap, making sure you build that into the cost. These are typically set for 3 years, and then you have to buy another one. And then make sure you build in a little interest rate cushion. So right now your all-in note rate might be 3%, but it might stair step. I did 25 basis points in this example over time. And so let's go, if you decide, all right, this is what I'm going to do, then let's go through the process because it's a little different. I would say pre-screen the deal with Freddie. So we'll go in, we'll need personal financial statement, schedule of real estate, resume, year 1 pro forma, and CapEx budget. And this pre-screens the deal with Freddie. This is very important because if Freddie's the final approver on these deals, and so you want to get in front of them, make sure they think, hey, this market, this property, this borrowing group is going to get lower leverage. You want to know that upfront before you spend a ton of money. If they approve the deal, they'll send the loan application to the borrower, and then you will sign. Let's say you sign the PSA, do your inspections, and then sign your loan application. This is going to be about $30,000 to $40,000 to get started. So it's going to be engineering, environmental appraisal, legal, and then processing the underwriting of the deal. Third parties will get engaged. That typically takes 2 or 3 weeks for them to go out, see the property, do their reports. And at this time, you're doing all the underwriting of the sponsor's property management company. And then usually about 45 days is when we'll get loan approval. And the big things here, number one, Freddie is going to sort of peg a insurance number for your premium. And you need to make sure you hit that number. If your insurance goes up, they're going to resize the loan. And then also your collections. So on refinances, you're in control, but your seller's in control of your collections. So make sure the collections are good because they're going to take a T3. If it's declining, they're going to take a T1, and that could materially impact your net rental collections, which impacts your NOI and debt service. Once you have approval, good faith deposit is typically 1% to 2%, locking that spread that you were quoted at the beginning. And then you'll go out about 24 hours before close, the day before close, purchase your interest rate cap. I'm estimating about $50,000 just to be safe after your approval, and then you close the loan and the deal. So, a lot of questions about interest rate caps is, all right, what determines the cost? And there's 3 things. One is, all right, what's the loan amount? That's the notional amount. The term, so how long you're going to go out, and then the strike rate. So the strike rate is what the actual lender is requiring, right? So, and that is the number you're capping. So if it's SOFR, for example, SOFR right now is, let's say 10 basis points. They're going to tell you that you have to go out and cap it at 2%, for example. So you put in the strike rate of 2%. So here in this little calculator, you have $20 million loan, 3 years, and a strike rate of 2%. So that costs you about $20,000 right now. I think this is quoted on Libor. SOFR is going to be a little bit more expensive just because there's not as many providers right now. But see, if you wanted to come down and let's say 2% is your strike rate and your spread was 3%. So your all-in rate for the first 3 years could not go above 5%. All right. If you came down and you said, all right, I don't want my interest rate to go up at all. I don't want it to go more than 3.5. So that's a 50 basis point strike rate plus your spread of 3%. Now your highest interest rate, all-in interest rate, can only be 3.5. You pay $49,000, and that caps your essentially SOFR rate at 0.5 plus your 3%, and that allows you to, I guess, sleep better at night. So some people will go lower strike rates than required. Most of the strike rates that we're seeing are in that 1 to 2% range that lenders are requiring. But you can see that, after the 3-year mark, you go from 3 to 4 year, it basically doubles the cost of your cap. And so what they allow you to do is buy a 3-year cap, and then towards in year 2, when you're getting closer to when that's expiring, then you go out and buy another 3-year cap. So we had that in multiple in the scenario that we showed the case study before. All right, so we're getting a lot of questions also. What's the difference between SOFR and Libor? So I saw this presentation that was really good about sort of what the difference was between. So everyone's familiar with Libor. It's been around the longest. So this is more of a survey. So they asked the banks sort of, what they think the rate should be, but it's not based on any actual transactions. Whereas SOFR is based on actual transactions between banks. But the amount of Libor compared to SOFR. So I think this is in billions, but there's about 250 times more in Libor trades or Libor action than in trading volume in comparison to SOFR. So SOFR is still relatively new. I think they announced it back in 2018, and it's the SOFR rate is supposed to transition or be effective by the end of 2021. So that's what Fannie and Freddie are quoting all their agency business off of now is SOFR, starting October 1st. And so here is sort of a comparison between Libor and SOFR in terms of cost of interest rate cap. So, 1.5% strike on a $25 million deal loan with 3-year cap. You can see SOFR is about 15,000 more right now, just depending on the strike rate. So build that in, and I would cap at SOFR now, so you don't have to worry about any transition between Libor and SOFR. So my background, born and raised in Houston, went to school in Austin at UT, was an underwriter at GE for 8 years, underwriting every type of commercial property. And then since then have been at Old Capital, originating close to $800 million in multifamily loans across over 125 properties, invested in close to 6,000 units across 21 properties. And, a lot of people will ask sort of, why should I use Old Capital? Here's a little spreadsheet that I made for you guys. And, we offer everything, right? So Fannie, Freddie, Bridge, CMBS, HUD, construction. Whereas a lot of lenders or even mortgage brokers, they have a lot of mortgage brokers work on all types of properties. We really focus on multifamily, so we understand this business and what loans are the best loans. Direct lenders typically have one type. Listing brokers typically have one type. And I think in the middle of this, right? So whether you're looking at most people will quote deals. We help you walk deals. We'll help you win deals. We'll do a bunch of stuff beforehand to get you educated. And then during the deal, we're a second set of eyes for you on these properties. And we'll, toward the deal, connect you with vendors and really represent you, the buyer. And then after that, in terms of asset management support, highlighting you on podcasts or conferences. And we essentially get paid the same. So they're going to charge you 1%. We're going to charge you 1% at close. And if you haven't registered for the conference is coming up in the next month, October 20th and 21st. This is going to be all virtual, 6 hours of networking through breakout rooms and 6 hours of speakers. So these are some of the smartest guys that we're going to be interviewing about what's going on in the market. So next steps, if you like this channel, definitely subscribe, like the video, join the email list. And then if you have a question about a deal, email me T12rentrollom or just investment package, I'll take a look at it, give you some feedback, and set up some time to talk with me about your next deal. All right. Thanks a lot, guys.